Hey traders, Dr. Barry Burns here with Top Dog Trading, and today we're going to talk about Forex strategies, specifically how to use trailing stops. And trailing stops are stops that you move as the market continues to go in your direction, so that if the market goes against your position, you don't lose so much money. So let's get right into it. And here's one technique. There's several techniques that can be used. I'll talk a little bit about the principles I believe in, and then also share with you one specific technique that I use all the time. So let's say that you went long, and we'll just use this example over here. And let's say you went long there. All right, we had a momentum shift pattern, and we are now looking to go to the long side. Okay, so my initial stop would be immediately underneath this low. The reason for that is this is my cycle indicator, my timing indicator, and very important to have a timing indicator on your charts. So think about that. What is a chart? A chart is a two-dimensional object, right? So we have down here at the bottom, let's see where you can see this. So down here at the bottom we have the x-axis, which is time. And over here we have the y-axis, which is price. And that's it. A chart is a two-dimensional object. And a lot of people look at price, they look at volume, and that's all great, you should. But it's very interesting to me that very few people actually have an accurate timing tool. And if you don't have an accurate timing tool and know how to use it, that means you are neglecting 50% of the information on that two-dimensional object we call a chart. Well, how in the world can you establish a probability scenario for yourself if you are eliminating and not even considering 50% of the information on the two-dimensional chart? So that's why you must absolutely positively have an excellent timing tool so you know when to get in, when to get out. And we use that not only for when to get in, when to get out, but also for our trailing stops. So, by the way, if you're interested in my timing tool, my cycle indicator here, it's not the topic for today, but send me an email or click one of the links here, and I'll invite you to a webinar where I will give you the indicator for free and teach you how to use it for free as well. Okay, so anyway, what we're doing then basically is we are just moving the trailing stop, since we're long, under every cycle low. Now, the cycle low is determined when the colored line gets down here to about 55. So this would be your next cycle low. So after the market goes up here, it's a cycle high area, then I would move, and that cycle low is established, I would move my stop from here, take it away from there, and I'd put it right underneath that low. Usually with Forex, I'm going to do it 1 pip plus the spread. Then, let's see, our next cycle low is over here. So it would go right below these bars here. Okay, next cycle low comes in here. So here's the marking on the indicator. Next one's over here. So we put it under here. The next one is here. There's our next cycle low indication. And so we put it there. So as you can see, as long as the market is trending, putting in basically higher highs, higher lows, we're going to be able to stay in the trade. Now, it's not exactly quite that simple because trends have a certain average length of time that they last. And so we're taking that statistically into consideration as well. We don't want to overstay our welcome. But the point is, once we make a profit, I usually will lock in some profits. If I buy here, I'll lock some profits in at the very next cycle high. And that does two things: put some money in my pocket, and then if I get stopped out for some reason, then I'm not getting stopped out on as many lots, not as much size. So my losses remain small. And that's critical, absolutely critical. So another thing we do is not only our trailing stops, but we also look for targets, meaning that as the market reaches certain levels, we will go ahead and take some profits. And the reason for that is because if you only use trailing stops to get out, then you're giving back a lot of money as the market retraces down. We like to lock it in near highs. So it's a money management technique. It's part of the money management that I teach in the course. Again, beyond the scope of this particular video, which is specifically on trailing stops. So this is one type of trailing stop. There's others. And let me just finish up by saying two things. So this type of trailing stop is based on a very, very specific principle. And that principle is this: stops go where you're wrong. That's the basic principle of stops. So what do we mean by where you're wrong? What I mean by where you're wrong is when the reason for you getting in the trade no longer exists, your trade should no longer exist. You should be out. So, for example, if we bought this cycle low here and market goes up a little bit, maybe it hits the moving average and comes down and takes out this low, well then the reason for me being in this trade long no longer exists because I was buying a cycle low. And that cycle low now is violated, therefore I need to be out right below that. So the reason for being in that trade no longer exists, therefore the trade should no longer exist. So that's number one. Number two, the very popular type of trailing stop is using average true range, meaning that they incorporate volatility into determining how far to keep the stop away from the current market position. I do not like, personally, those types of trailing stops, and there's two reasons. Number one is they're usually too far away from my entry, and therefore I can't hold to the cardinal principle of keeping your losses small and letting your winners run, that the losses are being big instead of small. Doing it this way, my losses are puny, tiny. Also, I don't like it because there is a natural cycle in the market of the market going between expanding volatility and contracting volatility. So these type of trailing stops, when they measure volatility and base the trailing stop on that, the problem is by the time an expanded volatility is measured by whatever indicator you're using, you've got enough data to measure that expanded volatility, often you're about to go into a cycle of low volatility, and therefore those stops can be taken out, or vice versa. Worse is actually vice versa, when your measurement is of a low volatility and then the market's going to go into high volatility and take you out. So for that reason, because they're based on historical volatility and there's a cycle between changing from high to low, I don't find them to be helpful moving into the future in real time. So that's the lesson for today. By the way, this was a request from one of my subscribers. If you'd like to subscribe and get notification of when I do these videos, feel free to click the subscribe button down below. And if you like this video, hey, please click the like button below and leave a comment telling me what you would like me to cover in the future. This very video was done in request to one of the comments from one of my other videos. So also I'm giving away one of my favorite trade strategies. It's called the Rubberband Trade. And I'm going to give you the trade, all the rules, the setup, everything. It's got a very, very high win-loss ratio. It's a simple strategy. You can learn it in about 20 minutes or so. And you'll get the video explaining that trade strategy absolutely free by simply clicking on the image in the top left corner. Or if you're on a mobile device, you can click on the little eye with the circle around it at the top right corner of this video. And that's if you're on YouTube. If you're not on YouTube, you can click on the link in the description below. And once you do that and request the video, I will personally email the video to you.